There's been much rejoicing at the increasing clearance rates at the start of 2013. Joining me on the panel today to talk about where it's all going, from Empower Wealth, Ben Kingsley, from the REIV, Robert LaRocca, and from Fletcher's Real Estate, Tim Fletcher. Robert, kick us off. 72% was good figures.
Look, it's been a really good start to the year. It's added a bit of life into the market, really, and around the traps, because we had 2 years of a very slow market, low levels of transactions, not a lot of change. And what we saw in December quarter was an increase in transactions, and that's flown through into February. We've seen the clearance rate steadily increasing. 70% is really healthy. We've had good volumes, so there's a bit of life back in there, and it's really just a reflection of improved levels of consumer confidence.
No fear of the dead cat bounce?
Look, I can't tell the future. I've tried. It doesn't work. What we do know is that there's confidence there. And when we look at all the measures and go back in time, we find that, improved levels of consumer confidence are the prime determinant about the health of the real estate market. And it's been tracking up for the last year, slowly, but it's been tracking up. So, that says that as long as consumers remain reasonably happy, it's going to be a reasonable year.
Ben Kingsley, you're a man who likes digging into the figures and tearing them apart. What have you found?
Look, Des, from our point of view, the clearance rates are an indication of pent-up demand, what Robert was saying before. And I think it's really important to understand that with interest rates going down, the measure of affordability is obviously opening up more doors for more people. So the sentiment sort of says, let's wait and see. Now we're seeing this pent-up demand, and people come through Christmas and New Year and then say they really want to make a decision. And then all of a sudden, that's it, we're moving, we're either upsizing or downsizing. And from an investor's point of view, they want to see the owner-occupiers come into the market, because that underpins the demand that they're looking for.
And it does, you get that feeling people are just holding, and then once someone makes it and runs for the exit, they're all off. Des,
and the statistics prove that when you see an increase, you can have a run of 15%, and then it plateaus out, and then you have a stable period like we've had for the last 2 years. So it's not at that general, lineal increase that we normally see. That's how we flatten it out in the data analysis we do. But the market moves like this, and so if you're not in and you don't time it well, then obviously you see challenges, certainly from an investor's point of view. So,
is it too late to have timed it this time?
Well, look, I wouldn't say too late yet, but I think Easter will be that determinant. I mean, in terms of, we might see as much as 8% growth in this Melbourne market in terms of the inner city and the city fringes, 8% by Easter. Now, that won't be reported until probably the middle of the year, because there's a lag in terms of when that data is then captured and released, and settlement delays. But we are seeing certainly a lot more people going to open for inspections, and we only need 2 or 3 competitors at an auction to get that price growth that we're looking for.
Just on the 8%, I agree entirely with what you're saying. I think it's important to point out that, and someone said to me the other day, well, our suburb's gone up 10%. I said, well, yes, it's gone up, but some might have gone up 20% and some might have gone up 3%. Not everything goes up uniformly, so, people shouldn't just presume that happens, but there's no doubt there is a great deal more confidence around.
Are you noticing just out, I guess, at the coalface, people are fronting up more, and people are starting to ring and say, well, it's time?
There's a definite change, and in fact, we noticed it back last September, and it takes a few months for it to sort of translate into something fairly tangible. But really, I think now, when we look back now at that time, it started to gain momentum then. There was greater confidence, and as Robert pointed out earlier, one of the biggest problems with the marketplace was the lack of supply. Turnover was down to billy-o. Now, compared to last year, we're about, in terms of auction numbers, we're about a third more than this time last year. We had a clearance rate that averaged below 60. We're now over 70. There's some profound changes in the marketplace. I think we're seeing the mums and dads who are upgrading and downgrading and that sort of thing, the people that want to live in their properties. The investors are getting back into the market, the first-time buyers. It's a vicious circle, but it's certainly very encouraging. I don't want to see a market we saw years ago where it got out of control.
What we need to see in this market is, in the past, we've seen a rising tide lift all ships, and that's what happened in the Melbourne market when we saw that economic boom and we saw the population growth. We're not going to see that this time. This is going to be in pockets. This is going to be in areas that people are choosing to live from. Property investment and growth is a study of the economy at one point, but when you've got a huge economy like a Melbourne market, It's more a study of human interest and human behaviour. You know, it's the people who want to choose to live there but have the ability to actually afford to live there. And there's a limited supply of that particular stock. So we're going to see pockets of the market doing really well, but I'm not necessarily claiming an 8% across the market, nowhere near it.
Yeah, the increased supply is an interesting point, because last year the strongest weekend of the year auction-wise was actually the biggest one, you know, when we had well over 1,000 auctions, and it sort of defied common, convention. People go, well, hang on, demand, supply, there's more properties, therefore it'll go down. And you think, well, no, because every house is not suitable for every buyer. They're looking for the house for them. So, and we've got this coming up again in the second last weekend of March, just before Easter. We're going to have the 9th biggest auction weekend in Melbourne ever. Straight out of the last 2 years, straight into an incredibly large weekend.
How many?
Just around 1,140 at the moment. That'll shift as we get closer to it, but that's a really strong weekend. And these are people who decided to visited their real estate agents in December and decided to list their home. So it does take time to flow through, but there are clearly a lot of decisions made by prospective buyers and sellers around Christmas time, and we're seeing them play out now.
And we've got to understand that those sellers are the next buyers.
Yes.
So, they're either downsizing, but we all need accommodation. It's an essential need. We're not going to move into the caves. So I think from that point of view, what they like to see when they list their property is other properties that meets their needs.
Yes.
When you see a downturn in the market, the stock that usually comes online is, B, C grade stock. And so people who are thinking, I want to upsize into the next best property, they're actually not seeing what they like out there. So they actually sit back as well.
Thanks, gentlemen. Sounds like an exciting time ahead in 2013. Look forward to hearing more from you throughout the year.
MPTV is brought to you by realestateview.com.au and the Real Estate Institute of Victoria.